Howdy, Jacob here. Today we're looking at cross-country healthcare in the healthcare providers and services industry. $500 million market cap, pretty much the same enterprise value. For smaller companies, I do like to look at insider ownership, and we can see it's about 5.2%. That's pretty reasonable for companies under a billion. Prefer to be double digit at least, but again, it's just one metric versus all the rest of them. So just something to keep in mind. And the growth has been absolutely astounding the last 10 years. It looks like it's pretty cyclical, though. You see 3 years of actually negative growth and then two humongous growth years of 100% revenue, 67% revenue. And it looks like, I presume that's, yep, okay. So there was a huge jump from COVID in the healthcare field, but there was also some acquisitions here. And the margins are a little bit suppressed on the gross margin side, but are getting to upper single digit on the operating margin side. No dividend paid. Return on invested capital recently looks very solid. And so let's look at some things here. Income statement. No R&D. It looks like cost of goods sold is really going to be the hefty amount of their costs here. Sales and general admin a little bit as well, which you can see jumped a bit from the acquisitions, but good production of earnings here. A little bit of share repurchases over the last couple of years. Balance sheet has 17 million cash on hand, no short-term debt, no long-term debt. So it looks like they are out of debt. That's a positive sign. Accounts receivable dropped quite a bit. That's interesting. Cash flow statement shows that, again, huge drop in working capital. Cash from operations recently, phenomenal, $200 million. Relation to their market cap, I mean, you're looking at a 2.5 price to free cash flow. But the thing that I have trouble with is they did make these acquisitions, and it looks like since these two large net acquisitions have been made, free cash flow has looked absolutely astounding. But we just have 2 full years of experience to work off of here. It's not a whole lot. And so I will be balancing out, what I want the company to do with what they've done in the past and such. And when it comes to free cash flow, I'll probably be here on the side of conservatism. They have paid down debt, bought back a little bit of shares, and then made some acquisitions with their free cash flow. Their debt is done though. So now if they do keep producing over $100 million in free cash flow, I wonder what they're going to do with it. If they were to buy back $100 million of shares, they're buying back 20% of the business. That is absolutely humongous. And if the stock's at a cheap price, that could be a fantastic investment. It's just, again, whether they can keep this free cash flow going or not. If you understand this business and you're confident that they're going to make $100 million in free cash flow at least a year over the next couple of years, then you're buying 5 times free cash flow. I think that's an easy decision. In 5 years, money back. From there, just whatever else happens. But for me right now, let's make some assumptions. On the revenue growth side, it's tough because there was acquisitions here. If this was just organic, I would try to see what was the growth beforehand to see where I think it'll go over the next 7 years. But there is some acquisitions here, so it's definitely going to be a bit of guessing here, maybe 3%. And then for margins, maybe 4 and 6. I want to do a good range here. Buying back of shares at 6%. 6% margin. You're looking at about 110 million. That's a lot of free cash flow available to do some work. So if they buy back, 1% is just 5 million. So 15 million, 20 million, 26 million is 4%. Yeah. Let's hear off caution since they haven't done it much the last couple of years. And then terminal value. So they provide talent management. I'm sure there's a whole lot of competitors here. So let's say do 10, 10, 15. Yeah. Okay. So here we're saying 3% revenue growth, 4-6 on the margin side. This is going to be using a little bit of reinvestment and acquisitions to grow from here and to keep those efficiencies in place, keep those margins in place. 3% share repurchase is actually nothing for them with their current free cash flow. That's just $15 million plus the 7 million of stock-based compensation, 22 million. Again, of the last 2 years, that looks like nothing, but whether they can keep that up or not is a different question. 10 PEs just being a bit on the conservative end, saying that there's a whole lot of people in this industry. They're a very small company. Can they compete? But even with a 15% return, we're looking like it's almost there. So this could be an interesting company to do some further research in. And yeah, I hope it's not too much longer till I look at the company. Hope you enjoy the video and have a great rest of your day. Thank you.